For those who are also looking for interest rate drops and the market to come back in line, I think you'll also find that that's also going to have a negative effect or a inverse effect, and we'll probably end up seeing interest rates stay higher for longer, both on the fixed and the variable rate side. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. Man, I am looking forward to the day that I do not have this much new federal news to talk about when it comes to the podcast and get back to talking about really just money and the fun things that we can do with it. Now, this is so important to have this conversation because it's so easy to dwell on the negatives around everything to do with the federal budgets and the marketplace and what's happening and what all the naysayers are saying about the marketplace. But I choose to take an opportunistic spin on virtually all of these things. However, there are still some changes that we need to talk about. And we need to talk about them because the more we talk about it, the sooner we'll be able to figure out different ways around it and what you need to do, whether it's about your personal investments, your personal properties, your real estate business, or anything else. So today we're going to talk about the federal budget and what changed and how it could impact you. We're going to also talk about how those items in the federal budget impacted the overall rate market, which leads into a conversation about how people are quote unquote shopping for mortgages and rates right now and why they're making a massive mistake right now. Now, if I can pack in any more, we'll talk a little bit about what's going on in the renewal market, but I think I might save that for a future episode because that needs a 45-minute conversation with so much happening there. So let's dig in specifically right off the bat into the federal budget guidelines. All right, so unless you were hiding under a table, you know that just recently the Liberal government announced, or the federal government announced, a whole new budget for 2024. Yep, a new budget for 2024. And if I can just kind of sense what's going on in the marketplace, there was a lot of nervousness out there about this potential federal budget, probably because they started leaking out some of the potential changes beforehand. And I think just generally speaking, not to make this political, but there's a very, very, very low confidence level among most entrepreneurs or people in the industry or anybody who really cares about housing in how this current government will handle housing going into 2024 and beyond. Suffice to say, unsurprisingly, the actual budget itself was a massive letdown. Now, again, I'm not going to be a big naysayer here. I guess it could have been worse. There are some ways it could have been worse, I think. Not sure how, but it could have been worse. So let's talk a little bit about actually what happened and how it impacted you and perhaps unpack some of the ways that you can go about this. Now, before I get into it, I will let you know I am not an accountant. I am not a lawyer. You need to talk to your accountant or your lawyer about these items below to make sure how it impacts your situation, to confirm how it impacts your situation and your costs and your potential taxes and information. Talking about taxes, this is really what this whole budget about is tax on tax on tax on tax. If you want to keep saying tax, we can keep talking about taxes, but I think you get the point. Let's start with the big one. Capital gains tax. Now, a little backstory. For those of you who do not know, where capital gains, typically speaking, is taxed, is essentially the sale of, in this situation, an asset, in this case, real estate. The profit that you make in the sale of a real estate asset is taxed. This is called a capital gains tax. Now, it's not just real estate, but today's conversation, we're talking about it. When you sell your property, the day that you sell it, the increase in profit and value, if you moved out of it, or from the date that you purchased it, is eligible to be taxed. So, as an example, if you purchased a property for $500,000 as an investment property, and then you sold it 5 years later for $800,000, you're eligible to be taxed on $300,000. This is the gains, so the capital gains. Now, where that doesn't come into effect is if it's your own property. If you own your own property, as of today at least, thankfully, you're still exempt from any taxes or any gains on the home that you currently live in. So if you live in the home, you are eligible to be exempt from any additional taxes on the money that you make, as should be the case in a free market. So let's go back to this. So up until just recently, or the recent announcement, you were eligible to be able to be taxed on 50% of the growth. So 500 to 800, $300,000 taxable. So you were taxed 50%. You were taxed at $150,000 at your marginal tax rate, which basically means the tax rate that you would typically pay. If you don't know what that tax rate is, you should talk to your accountant to find out because it changes on an annual basis. Anyway, so you were eligible to be taxed on 50% of that amount, 150 grand, as of, well, coming up very soon. I believe the dates that this is actually going to take effect is June 25th on 2024. You are now, depending on your situation, going to be taxed not 50%, but 66.7% of that increase in value is going to be taxed. Now, if you're a corporate, if you own your property in a corporation, as many people do who have investment properties, and many people do who own commercial real estate, you're going to be taxed at 66.7% of the entire amount if you are owning that property in a company, and you'll be taxed at 66.7% in the amount above $250,000 of income. Now, hold on a second here. That was a lot. If you own a rental property in your personal name, for the sake of this example, essentially, you would be taxed at the extra $50,000, 66%, and the first $250,000 at the typical 50%. Regardless, it's an increase in the income taxes that you're paying on this particular property. So what are they doing, and why are they doing this? Well, remember, our government is all about being fair, making the wealthy pay their fair share, even though we know that the vast majority of people who own investment properties are just everyday people who own them and take care of them like landlords. So essentially what they're saying is, well, we're going to tax you for owning a piece of real estate. And of course, if you were smart about it and tried to not pay a significant amount of income taxes, because you're allowed to do that by running it as a company, which you should be doing in most situations, well, we're going to tax you at 66.7%, a little bit more than we were before, an extra 16% taxes. For those who don't know, that's a pretty significant amount. And if you were trying to figure out exactly how much that equals in terms of a percentage, in BC, for example, where many of our listeners are, that would equate to going up from 26.75% marginal tax rate now to 35.67% marginal tax rate on the capital gains over $250,000. BC, that's that amount. In Alberta, that's 32% from 24%. In Ontario, for our listeners in Ontario, that goes from 26 to 35.6%. So very similar to British Columbia. No small amount. So why are they doing this? Well, remember, the rich have to pay their fair share of taxes. But what other reasons? Well, I'm not sure, but some things that initially come to mind right off the bat is what we call like essentially like a class warfare, basically saying there's no such thing. You can't have capitalism in our country anymore. You can't make your money, even though people have to still pay a percentage of their income taxes. What I think would likely happen here because of doing this is, well, it's probably going to lower the amount of returns on your capital investments. That's a likely outcome. In addition, it's going to essentially raise the cost of capital. So think about it like this. If you're an investor now, or someone thinking about investing into any real estate, and you want to get a return on investment, are you going to charge the same amount of interest on your money as you were before? Hell no, absolutely not. So we're going to see the cost of everything increase with this, because if you're going to tax us, we're going to increase our costs. And it's not the government that's giving up money to a majority of these resale properties and investors that are out there, whether it be real estate or otherwise, even though they say they're going to get billions of dollars. That's predominantly for apartment housing, which is rental properties, not properties that people want to own. The other things it's going to do is it's obviously going to impact foreign investment, because again, although Canada is a desirable place for people to come and invest, it's less desirable now because there's more income taxes. So they can start to look elsewhere, and they will start to look elsewhere. It likely will hurt productivity because, again, this isn't just a real estate consideration. Less taxes, less profit means less back in the marketplace. It's going to hurt jobs. Anywhere that's not exempt, it's definitely going to reduce jobs, which is a negative for the economy as a whole. Reduced asset turnover. So someone who owns a piece of real estate is less likely to sell it because of these considerations, which is actually not a good thing in our overall marketplace. I think overall, it's going to reduce the amount of cash available for anything and anybody in the real estate market, a startup, entrepreneur, these types of things. It's also going to suggest that more and more high income earners, like if you're thinking about this and you're a high income earner and you could live in Canada or many different states in the US, as we've already seen, why would you stay in Canada at this point unless you absolutely had to? So I think we're going to see more high income earners start to look for different ways to operate externally in in their businesses in different places, on and on and on and on. And I think at the end of the day, like the key to this communication around this is that it's going to probably end up costing more money in the marketplace than it's going to earn. Now, the government suggests that out of that 39%, that's going to be put back into housing market, although we don't know specifically how that's going to actually benefit people who live in Canada and actually want to own real estate in Canada, other than a few, again, random suggestions that they're going to build double what they've already built to this point right now. Again, I'm sound like I'm getting on an angry rant, but really there's a lot to unpack here, and it doesn't seem like there's a lot of positive. Now, if you don't recall, this new budget is $39 billion that we don't have as Canadians. And what that will also do is, we all know, it stimulates the marketplace. And when you're trying to get rid of inflation, you probably don't want to stimulate the overall marketplace as a whole. So for those who are also looking for interest rate drops and the market to come back in line, I think you'll also find that that's also going to have a negative effect, or a inverse effect, and we'll probably end up seeing interest rates stay higher for longer, both on the fixed and the variable rate side, which we're going to touch on here a little bit towards the second half of this conversation. So what's the good news, and what are the opportunities in all of this stuff? Okay, well, opportunity number one, as you may or may not know, if you were to borrow money against your existing property, this is not considered a capital gain. You just pay the cost of borrowing. So if you have this property that went from $500,000 to $800,000 and you want to cash out of that property, assuming you qualify, which obviously is not necessarily easy, but we can help you with it, then the other option there is you could borrow the capital. So you can refinance, assuming you qualify, to get access to the capital, which is non-tax. You just pay interest. And so I think that more than ever before, you'll see people start to explore the idea of refinancing and holding these properties until, maybe there's a new government in power that turns around these different guidelines and goes back to what we used to have and scraps this whole capital gains consideration. So I think we'll start to see people consider doing that. And then, of course, the other positive, which I mentioned, is that your primary residence is untaxed. Okay, so what are some of the other housing relevant pieces that we had talked about before? Well, we just talked about the inflation component and how that's going to negatively impact the overall marketplace and the stimulus associated with that. Well, the other consideration is that the Liberals proposed, I'm reading this through right now, that there was a targeted changes to mortgage insurance rules, essentially suggesting that they are going to consult on changes to regulation, including refinancing. Now, that doesn't mean they've actually done anything here, but there is a suggestion to consider that they may look at the possibility of allowing refinancing to be insurable again, especially as they roll out these new second suite programs, which, if you don't know what that is, the Liberal government announced that they were going to do a second suite program to get people to build second suites in the property with some type of incentives. We'll find out exactly what those incentives are, hopefully in the near future. But until that time, maybe we start to see insured mortgage refinances, which would be an incredible thing for consumers because it reduces the overall cost. If you don't know already, when you're doing a refinance, the cost of borrowing is actually higher than if you're just transferring a mortgage to another lender. So I think that would be really, really, really welcome in the marketplace and something that we would love to see. We already talked about the rental suites retrofitting. So there's money earmarked to some kind of secondary suite program, low interest program for up to $40,000 to add in a secondary suite. We don't know how that's going to work, but we'll find out what that looks like. Other considerations: lenders must proactively contact borrowers facing hardship and offer payment flexibility, such as 35-year amortizations. We've talked about this before. This is nothing new. There is a proposal to offer halal mortgages or support for halal mortgages. Now, this has been exceptionally controversial as the news has worked its way out. For those who don't know, your typical halal mortgage is not able to be financed by a normal bank. And we've had clients in the past reach out for these types of mortgages. It is a religious type of mortgage, I believe, and don't quote me on this, is primarily the Muslim religion. There are some lenders who will offer these types of halal mortgages, but instead of a typical interest accumulating loan, I believe the understanding is that there are additional fees up front or baked in, which make the cost relatively equivalent or higher. And so the suggestion or proposal that the federal government is going to look into ways to reduce the costs for them. I think that there is a lot of stress and angst in the marketplace about people who are wondering why they're going into this particular place and not looking for solutions for just the general public. I don't know the answer to that at this point right now, but I do know that there is something out there that is being talked about. Other than that, the federal government has, this is, I guess, one other key point, has increased the amount for upsized insurance limits for the support for multi-unit construction. So they'll permanently increase the Housing Act to essentially allow from $750 billion to $800 billion for mortgage default insurance to essentially help build multi-unit properties. Well, they basically announced that they were going to build double what we're currently building right now, somehow in the next 6 years, to try and meet the minimum housing capacity that is required to house the people that are currently coming to our country. That seems like an extreme and a very unlikely to occurrence at this time right now, but that is essentially what they're saying. There are some other small initiatives, if you will, and other considerations, but I think there's just no doubt at this point right now that the whole capital gains tax has divided an entire country of people. I shouldn't say divided. I think it's just really pissed off a lot of people and got them wondering what the heck is going on in our marketplace, and why do we have these income taxes continuously coming into us, or being brought to us, and what are they actually doing? Now, if you haven't been watching the market, and you probably wouldn't be unless you're directly involved in the real estate market, or an investor, or in the mortgage industry, or maybe in the real estate industry, there's been a lot of fluctuations that have happened this year already, and a lot of things that were predicted at the start of the year that aren't happening by a lot of people. One of the predictions is that we would start to see interest rate decreases by April, and now that's being pushed back to potentially June and July from the Bank of Canada. Another one of the predictions was that we would start to see fixed rates decline by this time. And if you go back to the beginning of January in 2024, we were seeing the bond yields come down. We were seeing interest rates come down. Heck, we were seeing 30-year, 3-year fixed mortgages not advertised, but after discounts in the high fours. That is now a thing of the past. With everything that's gone on, both in the United States and in Canada, rates are back on the up. In fact, they've been increasing steadily since the start of 2024, all the way from January when we saw that dip until today. Other than a small dip in March of 2024, we are back up to nearly 3.8%, with the projection right now meaning we could go as high as 4.2%, which could mean a significant increase in fixed interest rates. Now, all of this doesn't really mean anything unless you know exactly what you're doing, or you're buying in the marketplace, and or you're someone that's renewing, which leads us to the next point. There is going to be a significant amount of people who are going to be surprised and shocked because they heard their friend got a mortgage approval 2 weeks, 4 weeks, 6 weeks, 8 weeks, 10 weeks ago at a rate that is lower than what they're getting here today. And I think it will cause a lot of stress and anxiety. And so from our perspective in the mortgage space, from my perspective in the mortgage space, one of the biggest mistakes that people make is they don't actually truly dig into specifically what their rate hold is and if they were pre-approved for that rate option. Typically, when someone goes into the bank, they get offered a rate hold or a pre-qualification. But 9 times out of 10, when I offer a second opinion to those people, it's not the right program, not the right product, and they're not even qualified for it. And what that means is that rate hold is just thrown out the door and isn't even an option for them. So for someone who's shopping in this market today, whether it be for renewal or otherwise, you need to not only get a rate hold in hand, but have a properly qualified rate hold in hand for the right lender and solution and product, because otherwise you're going to just pay more money. So whether it's you as an end user or your client, you're going to pay more money because you don't qualify for that option. You see, I think a lot of people are under the false understanding or false pretense that whatever they walk in for, they're going to get when they walk away with. And we just know that's not simply the case. So for you, if you're renewing or purchasing, or you have a client who is, no, you definitely need to make sure they go through a complete 3-step audit process, which we offer our clients to make sure that they're getting the right options. Now, let's talk a little bit about why rates are on the rise right now and what's going on. Well, we just talked about what's happening in the United States, which is just like Canada, they're spending money like it's going out of style. In addition to that, we're also seeing that rate cuts aren't happening right now. And furthermore, the market is still coming in very strong. Because of those things, we are still continuing to see the yields in the overall marketplace stay high, and no real reason for interest rates to start coming back down. Other concerns that we're looking at, we've got the Middle East. There's a war going on in the Middle East, and that's wreaking havoc in the overall market, specifically oil costs. And so if you don't recall, oil, gas costs money, obviously, to run the entire economy. And when gas prices go up by just a few cents, it has a significant impact on the economy, notwithstanding the fact that we've seen gas prices rise nearly 30 cents in the last 3 to 4 months. That is already having a noticeable impact as it works our way through the overall economy. Now, there have been some other interesting little notes, but we don't want to go too deep on that point. We're going to talk a little bit about what this means for you in the housing market. Depending on where you're located in the country, if you're in Alberta, there's a certain market. BC, depending on where you're in BC, there's a certain market. In Ontario, we work all over the country. And so I get an opportunity to talk to different real estate agents and different people in different communities. And a lot of this is anecdotal feedback, but you can look up evidence depending on how current the evidence you're looking at is in the statistics. But there's no doubt that each economy is acting truly like a microeconomy right now. The migration of people from BC to Alberta is still happening, and Ontario to Alberta. Although depending on where you're looking, it's slowing down a little bit. Like Alberta's on fire in places like Edmonton. Calgary is still moving like crazy, but maybe not to the same level it was earlier this year or last year. Different areas in British Columbia cooled down from the extreme heat that they were seeing in the January-February timeline. And now what we're seeing is a lot of houses sit on the marketplace. So we're seeing the days on market actually start to pile up. More houses sitting there equals house prices that get stale, which means either sellers have to decide to reduce their price points back to something lower and reset their expectations, or properties come off the marketplace and we just see another fever of people chewing after what's left in the marketplace. Ontario, again, very unique marketplace. And depending on which city and which community you're in, we're seeing some properties just sit. We're seeing investors sell off in certain areas, and we're seeing some areas remain competitive. One thing is for sure right now, a lot of people are making jerk reactions, like quick reactions to the overall marketplace and freaking out, specifically investors and uninformed investors, or ones who bought properties based on making a quick buck in Airbnb. I shouldn't say that, they were looking to make a quick buck per se, but to make money in Airbnbs, people that were holding on pre-sales and other people that were purchasing different types of condo buildings, hoping to make money on appreciation. Those different types of investors are really starting to feel the pain right now. And what it's doing is it's starting to flood the marketplace, which is a welcome boom for a lot of the buyers that are out there right now trying to get a little bit of a deal in the marketplace. That notwithstanding, you have a crap load of buyers. In fact, we've got almost 100 people right now that are sitting in the wings waiting for rates to come back down, which I think is truthfully, I believe that's a poor decision. Whether or not the marketplace goes up or down by 5% really doesn't impact anything. The moment that rates come down, we all know the psychological impact of a 0.25% rate reduction. We just talked about it. In January, the market was hot because rates started coming down. And now the market's cooled off a little bit because rates haven't come down and they've stayed relatively close to the same. The only difference is that there's about a 2 to 3 week lag time in the marketplace before people actually find out. And so for that reason, if you're purchasing in a market like this right now, you can really benefit and get ahead of the 8 ball. In fact, I personally just completed a contract on a purchase of a home, knowing that the values could dip by 5%, but also understanding that over the course of the next 5 years, that property is going to go up and I don't have to fight with 10 people to try and buy this particular property. All in all, we've kind of weaved our way through a variety of different points in this podcast episode. And I think the key point that I want to take away here, don't leave me yet. There's a few key points to take away here. Number one, we are still in a massive state of flux. We are still in this place in our overall marketplace where we're recovering. We're still trying to determine what that looks like. We have millions of homes that are set to be built, but we are still underbuilt by millions of homes. So we still do not have enough housing. We have a low amount of supply. We are in a marketplace where a government is trying to fix the issues primarily by building rental housing, which doesn't address the goal of Canadians having home ownership, and who think that incentivizing new build properties where most people are not able to put down a deposit of 20% by giving you a 30 amortization, we think that that's the solution. That is not the solution, obviously. So what is the solution? Well, the solution, no matter what way you look at it right now, is to buy real estate and hold long term, to have a clear strategy around your mortgage so that you can overcome the bumps and the bruises, so that when the rates go up or stay up for a lot longer than you expected, you're prepared and you're ready and you know your worst case scenarios, and your worst case scenarios are probably not selling that property, but finding another way to deal with it. We're also in a situation of flux where more than ever, you need to be partnering with a pro, somebody who understands this, who can have this type of conversation with you, who can walk you through the whys and the hows, so that when you make a decision, you can stick with it and feel comfortable. And if you need to adapt, you can adapt to the marketplace. I get really passionate about that because I just think that in our industry, the barrier to entry is far too low, both in the real estate and the mortgage and the financial space, and people need real advice from real information. If you like this episode, if you want to hear more of this type of information, please go hit me up at Flow Mortgage Co. or at The Mortgage Pug. Or if you're on YouTube watching, please leave a comment below, good or bad, don't care. Hit that like button, hit that subscribe button, and let me know what you want to see more of. Appreciate you watching the episode, and we'll see you on the next one. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.